Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today, alongside my co-host, Tony Shore. How's it going, Tony?
Great. Jose, great to see you again. Great to be on your show. I appreciate you having me on once again. And I'm excited. We were talking for a bit about the topic you're bringing to us today.
Yep.
And it's a fascinating one. It's a hot topic. And I think it's something people need to know about. They need to know about this strategy and how they can utilize it.
Yeah.
And it can be very beneficial for a lot of people out there. So listen through the show. Jose, you always come prepared, well educated. We even have a couple of charts and graphs to show. So
Yep.
some visual stimulation during today's show. Just if you're watching on the YouTubes,
Yep.
the interwebs and the YouTubes. Yeah, if you're watching the video show, you'll have something else to look at. Besides, I realize the reason you have me here is for the eye candy. You're the
Yep.
brains, I'm the eye candy.
Exactly.
Everybody can see that.
Exactly.
No, I have everyone every day tells me that I have the perfect face for radio. I hear that on a day in, day out
That's a
basis.
great compliment.
Yeah, you have the perfect face for radio. I'm like, oh, gee, thanks. And then I tell them, I can always come back with, and you have the perfect voice for print. So there's that. But Jose, it's great to be here with you. How have you been?
I've been great. The summer is the slow season, so we're preparing a lot of great things here at Cooper Financial. We're because the last 3-4 months of the year tend to be the most busiest. So we're
Crazy.
just preparing and buckling down on all of our processes just to make things more efficient and just better for our clients overall.
Yeah.
And that comes with a new technology. The generational vault is out live now, so we're slowly implementing it and essentially sending it out to our clients and teaching them how to use it.
That's awesome.
And then other than that, I mean, for today's episode, I gave myself the permission to nerd out for a little bit.
Awesome.
I know we haven't done that in a while, and I should probably have Alex Hill, the friend of the show, my former economics professor, to get back on and nerd out a little bit more. But I just haven't had a chance to nerd out.
I love Alex, and I love when you had him on the show. That
Yeah.
is awesome. You two can really nerd out together on economics, and it's very educational, though. That's probably my favorite episode we've done.
Yep. I loved it too. So I thought I would take it upon myself to nerd out a little bit, just a little bit today.
Yeah.
And hopefully I don't lose all of you. I'll try to make it as entertaining as possible. And Tony, you're gonna help me also make it as entertaining as possible.
All right, we're in this together. But I know this is something you're passionate about and a strategy you've helped people utilize. So let's dig into it. Where do you want to begin, Jose?
Let's begin by, I want to tell people how they can leverage using fixed index annuities to create an efficient portfolio. Okay. Now, what does efficient mean?
Yeah, define that here. A more proficient portfolio. How are we doing that?
So there's this thing called, in the investment world, there's this thing called efficient market frontier. Efficient market frontier. Okay. Usually people say EMF. And essentially and it's a very basic concept, and everybody knows this kind of rule of thumb thing is that as the more risk you take, you're usually rewarded by a little bit more returns, right? And the less risk you take, the less returns you get, right? So in this efficient market frontier calculation, it's a graph and it's also a formula. It shows that essentially the more risk you take, the more returns you're expected to get, right? And if you eventually have an investment that gives no return, very little returns, but is very risky, that doesn't seem like a very efficient investment, because it gives you doesn't really reward you for taking the risk, right? So those
Yeah.
are the distinguishing. And then the thing that the holy grail is get insanely good returns with no risk. That doesn't exist, right?
No.
But
No.
but essentially that is how I define an efficient portfolio. Okay. Now the specific, if people want to nerd out on this and want to look this up on their own, the calculation formula is called a Sharpe ratio. And essentially, Sharpe ratio is for uh, any given return, what is my risk, which is calculated by standard deviation.
Yep.
So return divided by standard deviation. Okay.
Wow.
Following me so far?
Yep, I'm with you. I'm with you. I'm
All
with
right.
you. But I mean, and really, efficiency or effectiveness, it could be one way,
Hmm.
But I usually, when I think of fixed index annuities, these became really popular when all the baby boomers started to retire.
Yeah.
With all the baby boomers retiring, it's a popular vehicle because it minimized or got rid of the risk part and still allowed you some participation in the market, and they
Hmm.
really changed a lot of the rules to make them more competitive. The companies got competitive with each other.
Yep. Yep.
And before, with your old variable annuities, you had really high fees, and
Hmm.
you were totally exposed to the same risk as you were in the market. So
Yeah.
that
What good
didn't
does
do a
that do?
lot of people did not like that, and that's where annuities got a bad name. But then, so the insurance companies woke up,
Hmm.
and most fixed index annuities have little to no fees.
Exactly.
You can put riders on them, and with every rider is a small fee. But even with an income rider,
Yep.
usually the gains outweigh the fees by a lot. So it is a good vehicle, but I don't see, on that scale of risk versus reward, this one kind of goes against that maybe a little bit, right? Because you can still get some pretty good reward with your balance never goes below zero. You can't lose principal, in other words,
Right.
right?
Right. And I do want to step back a little bit on the annuity conversation, because
Sure.
annuities there's the world of annuities have changed a lot, and they're
Yeah.
so vast. I mean, one of
Yes.
the things that you talked about is variable annuities. I feel like variable annuities are very of things of the past.
Yeah. Not a
You
lot of
know,
people are using them these days because, again,
the
high
high fees
fees
mainly,
and risk.
and just being risky in general.
Yeah.
And but also, I feel like most people I talk to, when they think of an annuity, they think of guaranteed income, right? And they think of, well, I'm going to annuitize this annuity and get the guaranteed income. And what does annuitizing mean, just for the people that don't know? Essentially, it means that you give your money to the insurance company, and they're contractually obligated to give you this income for the rest of your life, X income, whatever it is, for the rest of your life. Okay. But that money is no longer yours. The lump sum that we were just talking about, that was given to the annuity company. Okay. And that's what people mostly know, back in the day. I feel like
Yes.
that's what they really just, I mean, if you look at the textbook and know what the definition of an annuity is, that's what it is.
Yeah.
Right. But again, like you said, these companies, these insurance companies, woke up and they started just offering more benefits
Yes.
and just having a little bit more flexibility.
Yeah.
They started costing
Which is good for
less.
the consumer, which
Yeah.
is good for us. Yeah.
Yeah. It's really just a great thing for the retiree, because they've reduced their fees, they've
Yep.
increased their benefits, and it's mainly because of competition. It's in the US, we have some great competition
Yeah.
within that industry, that
And
it
they're
just
competing with
forces.
banks to get your money to
Exactly.
put your money with them instead of the bank. So they have to compete with CDs, and they have to compete
Exactly.
with other things, right?
Exactly. So, and I'll get to the specifics on the annuities, but I want to jump into the investment world for a second.
Sure.
And what does that world look like typically? And as far as investments go, typically, if you go to, like at my previous employer, if somebody came to me and they said, "Oh, I'm a moderate investor," uh, and I was like, "Okay," and I'll just put them into a 60/40 portfolio and then call it a day, and then be like, the 60% equities, which is for the most part at S&P 500, 40% bonds. and then call that a day. And that's essentially it. And if you were a little bit more, you like to get a little bit more risky, then I would do the 80-20, 80% equities, 20% bonds. Now, why does the bond portion exist in there? Because, at least what I was taught at my previous employer is that that's your buffer, right?
That's your
If you-
safety.
Yeah,
That's your
safety
low
net.
risk. That's the little to no risk. But that was true years ago.
Exactly.
That the 60-40 when things were less complicated and the tax code was less complicated and
Yep.
retirement was less complicated and you didn't need as much money for healthcare and the
Yep.
tax situation wasn't as bad. 60-40 worked for a lot of people.
Yep.
But those days are gone, right?
They're 100% gone. And by the way, this is no radical thing. By the way, actually, most people that I've ever talked to, that I've talked to in the last couple of years, they kind of know. It's not an outrageous thing to think about that bonds are not what they used to.
Right.
And they're not, and they don't perform like they used to. And they're not as safe as they used to.
No.
So
there's risk.
Yes, there's very real risks with those bonds. And actually, funny enough, I think a couple months ago, I saw a Lehman Brothers bond in someone's account.
Okay.
And which
interesting.
Obviously it shows zero as the value.
Yeah.
But I thought it was
It's not
interesting.
worth anything.
Wow, it's almost like it should be put in a museum somewhere.
Yeah, exactly. It's a thing of the past. That doesn't exist anymore.
Yep.
Yeah.
But I was at this forum. It's called the Elite Advisor Forum, where I meet with all of our portfolio managers on their closed doors, and I meet with all the analysts in Wall Street. Met with JP Morgan, Goldman Sachs, Invesco, all these different DoubleLine was one of them as well.
Yep.
All these different analysts and economists. We all just got into a room and we just started discussing. Okay, what's going on now? What are we looking at? How do we interpret the economy today and what's going on in the market, and what can we expect forward? And as one of the, I think it was JP Morgan analyst was going through his presentation about what their consensus is, they came across they showed one slide that I thought was very interesting that essentially drives this point about what bonds used to be and where they're at today. Can you show that, Tony?
Yep. We have it right here for our viewers. If you're just listening to the podcast, go to YouTube, check it out, and you'll be able to see what we've got here.
Yeah. But essentially, it's a color-coded dot graph, and it shows where the annualized 5-year returns of bonds used to be like.
Yep.
And back in the 80s and 70s, you could see an expected return on these bonds be from 8 to 16, 18%.
Yeah, even up to 20%.
Is there one up to 20? Oh yeah, there is one up to 20. There's an outlier there.
There's some bonds. Yeah, it was anywhere between 8 and 20% during the 70s and 80s for bonds.
Yep. And then as you see in the 90s, it starts to come down a little bit, where it hovers between 6 and 10%.
Yeah, 6 and 10.
Which actually, this brings them up to my question, Tony. When did you buy your first home?
Bought the first home in the 90s. It was either 95 or 96, and we were looking at a house, and interest rates dropped from like 11 to, we got as a first time home buyer, we got 9.9%, I believe it was, like 9.9%. We were so excited to get it under 10 because everyone we knew had like 11, 12 right in there.
Yep. And then and today, thinking of a 10% mortgage seems outrageous.
10% interest rate on a mortgage seems outrageous. And guess how much my current home is?
How much is it?
2.9.
See, that's and
From
by the way,
9.9 to 2.9, and that makes a huge difference on the amount we're paying for the house and our monthly payments.
oh yeah,
Huge.
and then I got a house earlier this year, and I'm paying 6% flat,
Yeah.
and but and that's high, and I don't, in the current environment, that's high. I
Yeah.
mean, back in the
It might get back down
2010s
to
and even
2.9 maybe at some point, and you can refinance.
yeah, hopefully, but the times of having 10% mortgages, I feel like are long gone.
They
And
are.
I think the economy is going towards more of a lower interest rate. We kind of tested that from an economics perspective. That was already tested in the before COVID
Mhm.
era of how does an economy work on a really close to zero interest rates. And
Yeah.
even Europe had negative interest rates, which was
Yeah.
crazy. Now I think we have to gone through that period, which I would love to have Alex back again and talk about that specific topic, because I think it's a very interesting topic about how Europe got to negative interest rates and what was the consensus that we learned as economists from that.
Yeah.
But I'm getting away from the topic.
Yeah, the
But
bonds, on the bond topic, yeah,
yes,
boy, 90s were way lower than the 70s. And then we have the 2010s. Boy,
yeah,
it's
yeah,
way down.
exactly. But and that's going to be more of the norm, hanging out around where that purple.
Yeah,
I'm sorry, not purple,
0
orange.
to 4%.
Yep, 0% I feel like it's a fairly
Yeah.
normal for now on.
Yeah.
So
Yeah.
uh, so that's why we don't expect bonds to really perform like they used to.
Yeah.
The average bond, the nowadays is probably around 3% average
Mhm.
on an annual basis, roughly. And but and that's why I'm that's all been the consensus, and people kind of agree with me, and it's not a outrageous thing to think about. But now let's walk through two different scenarios, and I'll tell you how these annuities work that I'm talking about, because the ones that I'm talking about, the annuities that I'm mentioning in this example, are just basic annuities that just get invested into an index, and that's it. There's no
Yeah.
bells and whistles. It's just a straight annuity that gets invested into an index.
Yeah.
Okay. Um, Now, that it gets invested in an index, and it has a zero floor, right? When the market goes down, you don't lose anything, because
Right.
they put that floor, that the insurance company puts that floor in there.
So your principal is basically protected then.
Yes, 100%.
Yeah.
Yes. Now, let's say, first of all, let's look at what year-to-date returns look like. So, Tony, can you put that up there? Thank
Yep.
you.
There you go.
As we see, large cap stocks 14.5%, small cap stocks 24% year to date. International stocks, international developed countries 14.9, and emerging markets 22% year to date. And aggregate bonds, look at that, negative 0.2%.
Yeah.
I thought it's supposed to be the buffer. It's supposed
Yeah,
to be
the
the safe.
buffer is at a negative 2% return for the year, and
Yeah.
the large cap stocks are at 14, and small caps are at 24.
Yeah.
Yeah,
Yeah.
and they say overall the market by the end of the year, I heard the senior portfolio manager today from this morning I talked to for Gradient Investments, and they have about 10 billion in assets under management. He's been on
Mhm.
Bloomberg News a lot lately as a talking head, but he says he feels that we could be at we're going to definitely, we could even see 25% by year end based on earnings so far this year. So
Yeah, earnings came out really strong
yeah,
this season, and
yeah,
I mean, I can
we'll
definitely
see.
see that, but we'll
Yeah,
see.
yeah. I mean,
Uh,
nobody has a crystal ball though, right?
nope, no, we
Not
don't.
even Brad. Has Brad showed you his crystal ball? How he
Oh
predicts
no,
the?
I need to go and find it though.
Yeah,
um, but this is just kind of the the point kind of writes itself. It's negative
Sure.
0.2% for the year to date. And then gold, had really good performing years the last couple of years, and now it's 1.7%
Yep.
for the year to date. Um,
Bitcoin.
and
Ouch.
yeah, and these bonds and gold performances are very interesting because given where we're at today
Yeah.
in today's economy, bonds should be doing way better,
Yeah. Bonds,
and gold should be
bonds and
doing
gold,
good.
bonds and gold should be doing better.
Yeah. And but they're not, again, going back to the message, they're not what they used to be.
No,
Right?
no. Well, bonds especially. I mean, bonds have had such a rocky road, and that chart you showed earlier showed that the peak, the '80s was just the heyday for bonds. They
Mhm.
did really well, and so they're a good safety net.
Mhm.
But for years they did really well. But boy, since the 2000s, they've gone down and down. So yeah, I mean, and we look at the stock market and wow, I mean, it's been really good the last few years.
Mhm.
And they always say you got to say past performance isn't indicative of future results.
Yep.
However, we have the last 100 years of the stock market to look at,
Mhm.
and 75% of all years are up years. And
Yeah.
so
The odds
over
are
the
really
last
good.
100 years, the S&P, if you look at the thing, it started at zero, and it's never hit record lows since then.
Mhm.
It's only hit record highs, and it has drops. We had 2008 where it's 49%
Mhm.
down or whatever it was.
Mhm.
It was not good. But if you waited it out within the next couple of years, if you had a couple of years to wait, in that instance, you were doing really good because it more than recovered. So
Yeah, I mean, last year, I remember, I was on another forum, um, yeah, I was actually the forum that I was just talking about. It was in October of 24, I believe, that I went to that forum, and then we were just talking about at the time, I just thought it would be insane to think that the S&P would reach 6,100 by January of 25. Boy, was I delusional on that. And then
yeah,
now and
yeah,
then now I'm hearing people, "Oh, it's gonna hit 8,000."
yeah. We hear eight a lot. Yeah,
Yeah, and
we'll
I'm just
see.
thinking, again, I guess I'm very impressed every time
It's
by the
based on corporate
resilience.
earnings, and corporate
Yep,
earnings are up. I mean,
yep,
corporate earning, despite the Iran war, right? Despite the oil situation, which I
yep,
thought, I'm no expert. I'm not as in the trenches with this stuff as you are, or Brad Cooper, or Keith Gangle or Mike Binger at Grady Investments. Those guys. But my money would have been on the we're gonna have a bad year. By the end of the year, it's gonna be way down because of oil. And when
yep,
those oil prices went to over $100 a barrel, I said, well, this is it. The economy's gonna
yeah.
the our inflation's going to spike. It's going to affect earnings. People are going to stop sending money. That did not happen. In fact, the markets did the opposite. They kept hitting new record highs during this time. I'm like, well,
Yep.
that's weird.
Yep, and it's
So
definitely because earnings and people, companies are becoming more profitable
sure,
because and more efficient because now they have AI as a tool, which is a
yeah,
whole different conversation that I would love to
yeah,
have too.
sure.
But here, let's get back into it though.
Yeah, but
Um,
how can fixed index annuity? What does this tell us about how fixed index? You've explained why the old 60/40 using bonds for safety doesn't work. How
mhm.
do fixed index annuities help us here?
Well, the way you use a fixed index annuity, you wouldn't take away, replace the 60% of the 60/40. You would replace the 40%, which is the bonds.
Yeah,
So, um, I want to run through that scenario because
sure.
obviously an annuity is still a conservative tool.
Yeah.
So
Oh, yeah.
you would want to replace a conservative tool with another conservative tool, right?
Sure.
That's what you want to do. So let's play one scenario out. Let's say, uh, on this side, on one hand, you have a 60/40 portfolio. Somebody invested 60% of their portfolio into equities and 40% into bonds. Year to date, what do you think is would be their returns? Their returns would be 8.6%. Not bad. Not bad.
Yeah.
Okay. So now let's do the other example. What if this other investor did the 60-40, 60% equities, 40% fixed indexed annuity.
Mhm.
And in that fixed index annuity, this annuity offered them a 40% participation on the S&P 500. Okay.
Right.
And as we saw on that chart earlier, the S&P 500 is at 14.5. Okay. So they would only get to participate on 40% of it. Okay. So if you do the math, a 60-40 portfolio, 60% equities, 40% S&P, a fixed index annuity,
Yeah.
that would give this person a year-to-date performance of 11%. And that is, and by the way, by taking
More
less
efficient.
risk, yeah, maybe being more efficient
And-
because they took less risk.
And less risk. Yeah.
Yeah, exactly. And so this is a perfect example of how leveraging fixed index annuities and by replacing the bonds with a fixed index annuity makes the portfolio more efficient because it's less risk, and you can have a potential for more returns in general.
I think
And
that's huge. Obviously, it makes a big difference. And so, yeah, you get less risk, but more efficiency.
yeah, less risk, more returns. So always the goal, the holy grail of investments, you can call it as the holy grail is you get as much returns with the least amount of risk. That's essentially what every investor is trying to do. We're trying to use that efficient market frontier and get the most returns and less risk. Essentially, get better over time and more efficient.
But we hear ads on the radio from certain companies saying you don't want to. If somebody says an annuity, it tries to tell you an annuity is a good retirement vehicle or good for you, run because annuities are bad.
Mm-hmm.
What do you say to that? I say those people must not be fiduciaries, because if they were really looking out for the best interest of their clients, they can't you can't take one tool off the table. What if that tool is the best possible scenario? What if that's a better scenario for your client than, say, the bond? Then you're not acting in their best interest if you're taking the fix. Especially they're just using a broad term annuities. You can't just do that. There are how many different types of annuities out there, and annuity companies?
Multiple.
Yeah. And you as an independent advisor, Jose, have access to look at all the different insurance companies and say, okay, who's offering the best for this client? And is there a tool out there that's offered by an insurance company?
Yeah.
And people hear insurance company or they hear annuity and they get so frightened, but it's really changed. And it's not like you're just putting your money in and you'll never get it back. That those days are gone with this stuff. If you get the right type of annuity, that's why fixed index annuities are hugely popular.
Yeah, because for the people that know how they work and how to leverage them.
Yes.
But it's something that I would say about those ads is usually those people are kinds of people that are like how my previous employer was, where I would just put you in 60-40 and then say that a stock and a bond is going to fix all of your problems. And I think that's a very one-dimensional way of planning. I mean, I think retirement in life is a little bit more complex than just having a one-dimensional plan.
Yeah. And it's funny because I like how I heard an ad the other day. Well, we're a fee only based. And I know you guys are primarily fee based as well, but I like how they're trying to say you don't want annuities, you don't want to use an insurance company because somebody might be making a commission off that. And that's why you don't want it. We're fee based. Well, what they're really saying is all we have is a hammer, so everything looks like a nail to us. Because the hammer is your one answer. In other words, the market is your answer. We're going to invest in the market, stocks and bonds, and then you're set. If you're taking something like annuities off the table, so you're not fortunate enough to have a pension, you don't want you to create your own personal pension. I mean,
Yeah.
what do you think a pension or Social Security is? They're annuities.
Yeah, there are annuities.
That is the definition of an annuity. You put
Yeah.
into Social Security and you're getting a regular check during retirement for the rest of your life. I mean, it couldn't be more simple than that, but just using it for that, like you said, no, you really need to utilize it and make sure that you're doing it in the right way. And you don't want to put all your eggs in any one basket. You don't want
Yep.
all your money for retirement sitting in the market. I mean,
Mhm.
you're 3 years into retirement. We have another 2008. If 100% of your money is in stocks and bonds, it's probably it could derail your whole retirement, right?
Yep. Yep. And yeah, I just that I think it all deserves a conversation. Everything
Sure.
boils down to the conversation of, well, what kind of annuity do I need?
Yeah.
How is an annuity even for me? So because sometimes the answer is no, an annuity is not for you. Definitely,
Right,
I've
right.
definitely
And
have.
there's always, like you said, with every investment, there's pros and cons. You have to
Mhm,
look at, okay, liquidity, growth,
mhm.
and what's the other,
Taxes,
and
taxes,
taxes.
estate
Is it?
planning. How does this
Yeah.
all work? As a
There are many different aspects to it, and every investment has positives and negatives.
Mhm,
The S&P 500, great, but there's a risk, right?
mhm, mhm.
And annuities are great. You've minimized the risk, but maybe liquidity you want isn't there because oh man, what if something happens next year? I need $100,000 of that money. Well, then an annuity might not be the best place for that $100,000 if
Yep.
you need it next year, right?
But it
I
all
mean,
depends
it
on every
depends.
specific situation,
Yeah.
um, and and that's why everything it should be given an open-minded conversation,
Yeah.
and that's what I would love to have with people.
Yeah. Excellent. Well, it's been a great show. What a great discussion. And I'm sure people have questions, and I know you'd love to sit down with folks and hear from our listeners and viewers out there, Jose, to help them with this and to walk them through it and to look at their situation and what tool or vehicle or investment might be right for them. So, how can our listeners do that? How can they get a hold of you and the team there at Cooper Financial?
Yeah, they can give us a call at 888-390-5277, or go to the show's website, financialarmorshow.com.
All right. Well, Jose, great show today. Really got my blood pumping. I love it. I love it. A lot to think about.
We're gonna get more nerdy as the days come.
All right. All right. Thanks. I appreciate it. And listeners and viewers, thank you for tuning in. That does it for today's episode of the Financial Armor Show with our host, Jose Rodriguez.